Another break lower might be all it takes for a capitulation-style crash, so to speak, to unfold, and I'll show you exactly what I'm talking about when we get into volatility in today's session. Earnings season is here. There's 7 instances of Fed speak this week, and global tensions remain extremely elevated. So let's keep a level head and build a game plan that's based on logic for the coming week's worth of trade. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we certainly have a green-bodied inverted hammer, so in all credit, the buyers did do a great job of making that counter trend move in the upward direction. However, the sellers clearly stepped up at the highs of the weekly range, and they were able to push prices back down underneath the midpoint of the weekly range. However, because we do have a green-bodied inverted hammer, they were unable to move back down to the open or through the open for range expansion in the downward direction. It still begs the question, if this was going to be a stronger initiative rally in the upward direction, why were the buyers unable to keep prices near the upper third even of the weekly range? So to me, structure definitely falls in the bearish category. If we think about location on the bar-to-bar count, we do have ourselves a higher low as well as a higher high, which technically is a little bit more bullish than bearish. However, if you just extrapolate out where the settlement prices, the close of the weekly bar, were pretty much unchanged over the past 2 weeks in a row. The other thing that you'll clearly note here is in an overall trend context, we've just produced a beautiful lower high off of key structure. Let's not forget that we are in a weekly downtrend with lower highs and lower lows, and if you just extend this off to the right, this of course is rejecting the neckline of what you could consider a lower high double top on the weekly time frame chart. So does it make sense that this lower high is being produced in a key location for the bears to remain in control of the weekly downtrend? The answer to me would certainly be yes. Even if we do continue to make a move in the upward direction, is it going to change the weekly trend? The answer is no. Remember also that we can still get a weekly lower high on the back test of the double inside bar range on the bottom side, right, which we also know has a lot of prior structure back here. There are the 2 lows that we're looking to respect, and also the beginning of the FOMC breakdown, right? On the weekly chart, it would not be that hard to imagine that even if we do continue in the upward direction, that's the next stop ultimately for a weekly lower high to potentially be put into place. To neutralize the weekly trend, as we've been saying, you really need to produce an equal high much closer to the 450 area here. In terms of downside, since we are talking about downtrends, what's the ultimate target? Well, first and foremost, you would have to go back to these equal lows, but further than that, we know we have a target down here around 416.75. That's the monthly retest of the inverted head and shoulders neckline. I also just want to point out here that it's offering perfect confluence with the weekly 50 SMA, the blue moving average on your screen. So how do you play this to the downside as a weekly time frame trader? You're looking for a breakdown of the inverted hammer low to go back down towards this area, and once again, retarget roughly 416.75. When and if we get to 416.75, just as a reminder, that's this area back here. Really strong opportunity for a monthly higher low to potentially be produced. Are you going to get a break and retest? That is to be determined at 416.75. I would not be an aggressive short at 416.75. Obviously, to get there, it leaves a little bit of room to travel in the downward direction. What else can we take a look at here? Let's take a look at the anchored VWAPs from the all-time high and all the major inflection points that we care about. And what you'll notice is that the upper wick has also perfectly rejected the AI Mania anchored VWAP from here and the top of the overall move, the anchored VWAP from there. So once again, is this a logical place for a lower high to be produced? To me, the answer is absolutely yes. And again, we didn't even close above the neckline of the double top. We didn't close above either of those anchored VWAPs. And if we do start to breaking down through this anchored VWAP coincides with the bottom of last week's bar. If that opens the door for lower, do we have confluence for support around the lower anchored VWAPs? The answer is yes, for the potential monthly higher low closer towards that 416.75 area. So I still am a believer that the weekly time frame chart would suggest we have further to fall to test for that monthly higher low. If we come in with the Fibonacci's from high to low from here to here, and then of course from the AI Mania rally low up to the top, I just want to do a little bit of discussion about the 61.8. So the AI Mania rally from here, if we are going to get a 100% retracement, remember that odds increase for that the more time that you spend, in this case, underneath the 61.8, and that is under threat, once again, with the buyers unable to push away and close away from that 61.8. From this perspective, if we're taking this Fibonacci from here to here, just a reminder that healthy bull flag consolidation usually wants to stay above your 38.2. If we slip underneath it, that starts to go away as a more bullish theory. The last one, of course, is if this is going to produce a 100% retracement. Remember, just like on the smaller little Fibonacci we did here, you want to spend more time, in this case, over the 61.8. If we start to break down underneath that, the odds decrease for the 100% retracement all the way on up to the all-time high. So you can start to see how the low of last week's bar becomes an incredibly important inflection point, where if we start to close weekly bars underneath, the door is open for that larger downdraft to once again towards 416.75 as an area of interest. Last but certainly not least, let's take a look at the volume profile here. And what you'll notice is that we did not even make it to the point of control, the highest volume node overhead, but we did start to reject this high volume node just underneath. Once again, that is a rejection of the neckline of the double top and also the high volume node. If you extend the bottom of the weekly bar off to our left, what you'll notice is that we have a little bit of a volume shelf here, but if we break it, we fall through the low volume void, and the next high volume node of support is, lo and behold, closer to that 416.75. So right now, the weekly chart certainly has stronger suggestions for downside continuation, but we're willing to keep an open mind. Even if it does reverse in the upward direction, it's still a counter trend move until proven otherwise. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound this week, the number is 440.50, and that of course would imply some sort of nuanced higher high. If we're contained by the lower bound, the number is 422.56, and that of course is also implying a nuanced higher low. For the most part, expected move is about $2 wider than it was last week. So in my eyes, the expected move is actually neutral, but we're expecting more volatility, and that's pretty straightforward considering global tensions are fairly elevated at this point in time. We have earnings season as well as multiple Fed speakers this week, including Jerome Powell himself. From a trend perspective here, what do we see? Certainly a low, and there's an opportunity for a higher low here at 430, which is noteworthy because if we come from here to here, of course, that is a higher high. I wouldn't call it a firm uptrend yet because this is not confirmed as a higher low. We don't know if that's going to hold or not, and obviously from the weekly perspective, there are suggestions for lower here, also some weakness we're going to cover in supporting evidence today. So I'm a little bit skeptical of 430, but if it does technically hold and we find ourselves trading back up at these equal highs, we will technically be in an uptrend. Could you pull back further than 430 and still find a higher low? The answer is yes at 427.50, but I would not be fond of looking at 425 as a daily higher low. The reasoning behind that, if I just take out the Fibonacci's real quick and come from the lows up to the highs of this move, notice that would be a violation of your 68.1, which, as we just discussed on the weekly, usually implies more of a 100% retracement. You've given back too much of the move at that point in time. Do we have structure there? Again, the answer is yes. Technically, is it a higher low? The answer is yes, but the odds would not favor that with that much give back on the overall break to the upside. From a pattern perspective here, let's take a look at what happened with this overhead gap. Just as a general reminder, we had double-digit positive breaths on the Tuesday session, and the market could not close the gap overhead all the way. We were given a little bit of a gift with the Thursday gap up, and even then, with the gap up, gap fill, there was no indication, and I'm talking about the gap fill from the Thursday gap up, there was no indication for a gap fill reversal back up towards this 438.50. So it begs the question, if stronger buyers were really getting involved in this market near the highs of this overall move, why were they unable to close this gap structure? As we know, a gap represents basically no price action in that area. So leaves a bit to be desired from the buyers at this point in time, and that stacks up, obviously, as more of a bearish data point. The other thing to point out here is that technically on the Friday open, we opened back above this key level. We'll see it more granularly on the hourly chart in a second, but 433.65, we opened above it. If buyers were truly going to remain in control, we wanted to use that as an intraday high or low to come back up and test that gap one more time. It simply did not happen. Obviously, on the Friday session, you can see that the structure of the individual bar is a solid red-bodied bar that once again tests that gap range overhead, fails, and closes fairly weak on the lows near the lows of Thursday's session as well. Let's take a look at our trend line analysis here on the daily time frame chart, just as a reminder that this gap is also a back test of your head and shoulders neckline. So once again, is this a logical place for a lower high to be produced in the context of an overall weekly downtrend? The answer to me is absolutely yes. You'll also notice that we're still underneath a downward sloping 50 SMA. That is never really an overly bullish indication. The one thing that you do have going for you here is that the retest of 430 right around this area here is a recapture of our support trend line, which comes from the October lows, which are now off the screen, but that is a recapture of your basically swing low, major low from October, the trend line there. So that is a slightly more bullish indication, which once again speaks to if 430 holds, that's kind of your key daily high or low. If it breaks down, really looking a little bit uglier here for trend continuation to the downside from the overall weekly move in the downward direction, of course. What else can we say? Let's take a look at our anchored VWAP study from the bottom, and we'll throw that on a clean chart here. I just want to remind you, and this should be fairly straightforward from the weekly comparison as well, but all of the AI mania players after this move in here are back underwater. We've basically rejected this as an overhead anchored VWAP band. Once again, shouldn't be all that surprising considering the weekly analysis. And the last thing to point out from this perspective, at least daily, is that if we do pull back, that 425 is the top band or the top portion of the lower band, all of the more responsible, if you want to even call it that, quote unquote, responsible buyers from the October low who got involved at any of the other major pivot points in here. So there is a reason to believe that maybe a higher low is set in there. But again, my belief is that it's too much give back of the overall move in the upward direction. Let's take a look at the hourly time frame chart here, get a little bit more granular and walk through once again that failure from Friday. So if you're looking at this, there's that overhead gap that failed to fill on the Thursday morning session. But notice again, here's Thursday's breakdown. We closed right there. Friday, we opened back above this, which as you can see would have been a balance area. We can see it in hindsight now as a double top. That would have been the neckline. So we opened back above that as an inflection point, basically a gift to the buyers saying, hey, if you're long from up here, either you have a chance to hang on or you can get out for break even. Right? And if the buyers were going to take advantage of that, it should have resulted in a move higher. The fact that we broke underneath, found a lower high intraday underneath 433.65 and continued to retest 430, once again speaks to either buyers being tired up here or sellers stepping in for your weekly lower high. So I think that this aligns more so with the weekly analysis as opposed to a stronger bottom being put in place, looking for a major reversal across the index. What else do we see here? 430, once again, continues to be an extremely relevant data point because if we throw on the anchored VWAPs here from an intraday perspective, notice how these here, and from back here, this is the FOMC breakdown, start to provide confluence around that 430 area. So if this is going to hold, that would be a key component for the buyers to hold on to some sort of hope that the daily trend reversal is starting to become a little bit more firm. If it breaks down, all of a sudden everybody is back underwater from these short-term anchored VWAPs. If we take out, let's go ahead and just clean that up for a brief moment here. Let's take out the Fibonacci's on the hourly time frame chart as well, coming in from the low all the way on up to the high. This should be very similar to what we just discussed with the 425 level, but notice that the 38.2, if this is going to remain as a healthy bull flag, 430 needs to hang on, and that would be your 38.2 from here. As we discussed, 427 is a last-ditch effort. 425, pretty much no good at this point in time from that fib perspective. Let's take a look with the fibs from here, the FOMC breakdown high to the low, and once again, 38.2 becomes substantial because of the confluence here with the 38.2. You'll also notice that even when we did attempt to get above the 61.8 multiple times, it was rejected. Even the Friday high rejected and came back down underneath the 61.8. So the Fibonacci's mostly align with the bears being in control and 430 being the last ditch effort for the buyers if they are going to produce a daily higher low. In terms of pathing going forward for this week, what do we want to see? Of course, because the trend is down at this point in time, the hourly trend is down with equal highs, lower lows, lower lows, lower lows. If there is any sort of rally, a pullback and a lower high wants to be found off of 433.65. Bears will look to position here, stops go above, and the target is back to 430. Ideally, the bears want to see a continuation under 430. If we get a lower high under 430, that's where I would start to be a more firm believer that it's very likely we could come back down and retest 420.50. Remember that we do have unfinished business around this area that really kicks off the weekly downtrend continuation to search for your monthly higher low around 416.75. If you're a bull here, the alternate path, we're going to take out the other colored crayon today, is looking for some sort of double bottom, right? So this turns into a double bottom. Then the buyers want to see once again support at 430. Buyers really are more confident on a higher low over 433.65 to close the gap overhead. Those are the major situations that I would be thinking about this week based on all of the confluence. Let's get into some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, from a volume flow perspective, you can certainly see that there was a neutral edge overall on the week, which is substantial because by midweek, we were actually trading up around 400 million positive, which is very close to our substantial threshold. A lot of the damage was done clearly on the Thursday session, where individually on that particular day, we closed underneath negative 300 million. Speaking of Thursday, I mean, look at the devastation from the advanced decline line completely plunging in the opening session, whereas the price action itself, if I just zoom in on the futures Thursday morning, they were really more so sideways to even up into the early afternoon, whereas the advanced decline line really told the story and fell off of a cliff earlier as opposed to later, like the market itself. Friday is obviously bearish as well, closing in negative territory. This, in terms of volume flow, is also negative on Friday here. The tick, what else do we see? Usually we're looking for negative 5,000 or positive 5,000 as substantial marks, and we certainly hit that on Thursday and got pretty darn close on the Friday session. So overall, we do not have new money buyers. For the most part, it seems as though aggressive sellers are stepping back up into this market. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, what's going on here from a value area and point of control perspective? Let's take a look at Thursday and Friday. Obviously, value area lower individually on the day Thursday, but also overlapping to down in relationship to Wednesday. Point of control is also substantially lower, and Friday speaks for itself. Value area is lower in the session. Point of control is also lower as compared to Thursday. But let's take a deeper dive on this. Notice that Thursday's point of control closes inside of the lower distribution of Thursday's double distribution, right? Technically, there's a small string of single prints there in H period, which separate the upper distribution from the lower distribution, and most of the value area and the point of control fall in the lower distribution. That would really be an indication that sellers were more so the active trader on Thursday, as opposed to buyers in the consolidation here near that high of day. You'll also notice that the point of control closes completely underneath the value area from the Wednesday session. But let's continue one more day into the future here. Friday obviously opens back in the upper distribution, right? This little triangle, you probably can't see it on your screen, but this is the opening print of Friday's session, technically in the upper distribution of Thursday's session. So once again, this is a gift to the buyers. The buyers had a second chance to either continue the consolidation or even look for follow through, if not just get out at break even. You can clearly see that the value area and point of control moved to being overlapping to down, and certainly there is no acceptance in the upper distribution from the Thursday session. Once again, really showing us that the sellers have the upper hand at this point in time in terms of where the volume is actually transacting. And not to really extend things, but let's look all the way back to the Monday session, because Monday was also a double distribution separated by an area of single prints. Not only did we close the single prints, but the Friday, point of control closed inside of the single prints and underneath the upper distribution. So if buyers were really going to make something more substantial happen in the upward direction here, I could have imagined stronger closes out of the point of control, at least above the Monday upper distribution. It simply was not the case. Overall, I think that the market profile here is more suggestive of bears being in the driver's seat. The one thing that I will concede as a bullish data point is just like we had unfinished business at the lows around 420.50 in the SPY itself, we have poor highs, at the highs of Tuesday's session as well as Thursday's session. And because these are very precise touches here, technically that makes it a mechanical level as well. So if we do move in the upward direction, I would not really look for strong resistance closer to that 44.20, but we have to get there in the first place. It's one minor bullish data point in the face of many bearish anomalies that we just walked through. All right, so in the pinned comment below, I want to hear some feedback from you. Do you prefer version A, version B, or version C? We're trying version C today, this week, and the hybrid method, going SPY and the sectors, then the Qs, IWM, then supporting evidence, and you can of course see that on the screen now. So please leave feedback on the pinned comment so it's all in one place, and just leave the letter, we can take it from there. The weekly performance of the sectors reveals that at the top of the list, we were led this week by utilities, up 3.76%, followed by real estate and energy. Now, I don't know about you, but utilities are classically D for defensive, and they're also extremely lightweight in terms of the sector weighting. At the bottom of the barrel, we see the XLB for the materials sector, which is also extremely lightweight, down, or not down, but just up the least, up 0.13%. The heaviest weight risk on tech sector is here, about midway through the list, but certainly underneath, more than 1% higher, up 0.86% on the week. The reason I'm walking through this stuff kind of explicitly is because we did not have a rally here, which was led by heavier weight risk on sectors, which to me decreases the amount that we want to trust that rally for any substantial holding power in the upward direction. It really speaks to a counter trend rally being led by risk off sectors in the context of that weekly downtrend we were discussing earlier. Let's take a look at the structural charts. Utilities, it's a counter trend move. I mean, there's still a very clear opportunity for a weekly high underneath 61.4, and obviously, as we mentioned, being such a lightweight sector, even if it does continue to rally all the way there, it's not going to be enough to save the market if the tech sector starts falling off of a cliff again this week, moving in the downward direction. So utilities, kind of a moot point at this point in time. Real estate, same thing, extremely lightweight sector. Obviously, both of them extremely sensitive to interest rates, and you can see that as the week really wore on. The Thursday session, where interest rates were back higher, started to put more downward pressure on real estate, so pretty straightforward relationship there. Again, lightweight sector, not going to make or break us. Energy, also lightweight, but really speaks to a thriving economy to some degree, and what you'll notice here is that we have a chart that's Swiss cheese, and this, of course, is largely attributed to the tensions over in the Middle East. So we'll just keep an eye on the chart. If we're underneath and if we start rolling over back below this 89.25, I think that you're starting to build out a little bit more of a head and shoulders pattern here. If you really start getting price acceptance up here, it's more of a bullish force for the broad market, but just a reminder that this is still an extremely lightweight sector overall. Let's take a look at the financials sector, because this is do or die. We had JP Morgan report earnings on Friday. It was a big old failed move in the upward direction, closing a nasty red inverted hammer, and XLF itself could not get up and over that major inflection point here at 33.65. So if anything, this consolidation, even with pretty decent earnings from JP Morgan, which obviously faded throughout the duration of the day, does not look favorable for a constructive move. If anything, you're starting to really produce that weekly lower high on the back test of your double top neckline. So as long as we're below 33.65, to me, it's much more of a bearish force. If we start to get above it, it's helpful, but I would only be more confident on a higher low above for a stronger trend reversal indication. Let's take a look at the XLK heaviest weight risk on style sector, the tech sector. This is do or die, right? We did start to see this as a sharp pullback, and if this is an overall weekly balance range, this can certainly act as look below and fail, but in my eyes, everything is going to hinge upon this level right here at 166.50. If you pull back and you hold that level, fantastic. You can draw in some sort of pseudo trend line like this, fantastic, you're holding that. Nonetheless, the illustration is that this, as an hourly inverted head and shoulders, is holding the retest of the neckline, and I suppose it's more so neutral inside of this this as a weekly balance area. If we do not hold 166.50, I think it's kiss it goodbye. You have nothing more than just a lower high in this as an overall trend sequence. The weekly searches for lower. We go to the equal low, if not lower low. 157.75 is on the table, and that's really your capitulation style flush that we're going to talk about when we get to volatility in just a moment. XLC, a little bit of a failed breakout here, slightly concerned, noting that this, of course, more so aligns with risk on sentiment. Really strong move higher out of this as an overall balance range, only to completely fail. It's not even like we put in minor consolidation up here for 2 days. These are aggressive lower bars, red bars, obviously, on the daily chart. And unlike the S&P as a whole, this actually closed underneath Thursday's low, whereas the S&P, the SPY itself, closed right at the low of the Thursday session. So is this going to turn into a failed breakout? If so, look above and fail on the range technically means the bottom is the target. I'll give it the benefit of the doubt as long as we're over this level right here at 66.75 due to this acting as double bottom neckline. But if we start to slip that, not really looking great out of communications. XLP, kind of like the XLU, a moot point here. Any sort of rally attempt can clearly find a lower high well underneath 71, and to really be more constructive on a budding uptrend, I would say you at least need a higher low over this if there's going to be any sort of indication of a double bottom, right? If there's going to be a trend reversal, you got to get up and over that area. Just to give you the number, it's roughly 67.75 at this point in time. Next up, industrials, also not looking great. If you were a buyer here, you really wanted it to recapture and hold that daily 200 SMA, bullish consolidation above. Is there the opportunity for a higher low around 101? Yeah, you could make the argument for a really ugly inverted head and shoulders. It is possible, but for the most part, this starts to feel much more like a weekly lower high the more time that we spend underneath that daily 200 SMA. Not thrilled with the price action in this one. Let's take a look at the XLV, second heaviest weighted sector by market cap. As we know, also D for defensive here. It's playing kindly. It's playing nicely with its friends in the sandbox, really just going sideways in this as an overall range. Once again, it would have been better to be up here over that 130.25, but you'll notice how we just slop back and forth through it. Not a whole lot of respect for that level. I would start to think of this as an overall range. Notice that on Friday, we actually produced a higher high and a higher low. So more consolidation in here really keeps the market neutral if you're not looking for bearish outcomes. Obviously, bears just want prices back down underneath 129, and clearly, if you're counting weekly trend, this could certainly be a weekly lower high. Let's take a look at the XLY. This one also strikes me as incredibly concerning. This definitely stacks up as a bearish data point. If this was going to act as double bottom, again, you didn't even really make it over the neckline of that pattern, never mind getting into this upper consolidation from up here. So overhead supply continues to weigh on price action lower. This maybe you could count as like an hourly look above and fail if you were to look at it on a smaller time frame chart. We're also underneath the midpoint at 160.50 as of the close on Friday. So if anything, just expecting an equal low, and because all of these touches are so precise, I wouldn't be surprised to see an undercut there and a break for a stop hunt. Maybe you find support at the gap close and daily 200 SMA, but nonetheless, that would imply downward pressure for our S&P. Here's the XLB for materials, extremely lightweight sector. Not much to really write home about here. Certainly inside of an overall range, but once again, Monday and Tuesday were a bit more constructive over the top of this as a balance within the balance, and Friday, obviously, we're back down lower. So if anything, slightly bearish pressure for the S&P, but not a make or break. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, I think that we still have a market in turmoil with the heaviest weight risk on sector pointing in the upward direction here, the XLK. That would be a bullish indication, but take a look at the XLY. Doing the exact opposite. The XLF is trying to rebound from this equal low back here, and the XLV, which is classically D for defensive, is also still neutral around a slightly upward sloping 50 SMA. In terms of the XLC, with its failed structural breakout, it's finally starting to produce a little bit more of a substantial move in the downward direction, and it's been the steady outperformer for quite some time here. How about the lightweight risk off style sectors? XLP, a little bit of an uptick, but still in an overall downtrend. So it's not like we have a pure flight to safety from a sector perspective. Same thing with the XLU after that massive rout, and clearly an opportunity for a weekly lower high underneath a descending 50 SMA. Energy trying to hold on to its 50 SMA, and real estate, again, extremely rate sensitive, is underneath its 50 SMA as well. So markets in turmoil from this perspective. Let's take a look at some specialized ratios like the XLK versus the XLU. So risk on versus risk off. It's starting to put in a little bit of a topping pattern up here. And the key question is, does it break down further than the prior high? And we also know that we've been a little bit skeptical of this particular ratio, with the SHY being a replacement for the XLU, flight to safety. Let's take a look at this one, and what you'll notice is that there's still the opportunity here for a weekly lower high. We're starting to roll back down underneath a now descending 50 SMA here, obviously much more of a mirror to the broad market. So this sort of dials back the expectations of a full-blown risk-on style move. If we take a look at apples to apples, discretionary versus staples in terms of consumer spending, this box has my attention, right? Because technically we made a higher high here, and we're starting to come back down underneath that last high. Is this going to turn into a look above and fail? And if that's the case, rotate to the bottom, that would certainly speak to risk-off style odds coming back into favor for the overall market. Now, I don't want to be doom and gloom because there's certainly the opportunity for a higher low, but any further downside to test or even get underneath the 50 SMA starts to raise much more questions and would certainly add to the bearish narrative overall for our broad market. So now that we've concluded the S&P along with its sectors, we'll move into the QQQ and save the supporting evidence like the dollar, gold, interest rates, bonds, all that stuff for after the broad market as a whole. What do we see on the QQQ weekly time frame chart from a structural perspective? Certainly just like the S&P, a green-bodied inverted hammer here. However, the upper wick is far more substantial, and I would say it actually took back more than 2/3 of the overall weekly range. So it begs the question once again, if stronger buyers were getting involved at the highs of the range, why were they unable to produce a stronger weekly close? It's not really how stronger buyers act. In terms of the bar-to-bar location count, higher low as well as a higher high, but the close, as we know, is basically unchanged from the prior weekly close as well. One thing to point out here is that we are rejecting off of a resistance trend line, and because of that, you can clearly see how this is a lower high, and this, of course, is still a weekly lower high. From here to here, you get sort of lower low and a very nuanced lower low. The one caveat out of the QQQ is that if this is truly going to be more so just a sideways range, and this breakdown was look below and fail, remember that we never actually closed a weekly bar underneath the neckline of the double top. So far, we're still inside of the range, and there is the opportunity for a higher low here to keep the look below and fail on the table, and ultimately the target over time would be the equal high. Nothing about the inverted hammer would be overly assertive for more further upside or more aggressive buyers getting involved in the market, but it's the push and pull that we at least have to understand here on a higher time frame context. Let's do the same thing that we did over in the S&P with our anchored VWAPs, and you'll notice that we are rejecting the AI Mania anchored VWAP as well as the high anchored VWAP in here. If we do start to break down, I would say that the more substantial break is underneath the bottom of the range to then maybe come back in. The stronger monthly higher low has quite a ways to go. There's a lot of thin structure through here, and as we know, this anchored VWAP is not the strongest thing in the world. Noting that thin structure back here, the monthly higher low is much closer to 320 as a horizontal level. If we scrunch out the chart just a little bit and come in with these Fibonacci's from the high down to the low, just to look at that same magic zone, if you will, with all the confluence. Let's go one more from here up to here. Just as a reminder, this builds the case for the anchored VWAP, but we're still in thin structure territory. The more important area to me is this 61.8 and the retest of where the AI Mania breakout came from in the first place, as we know, closer to that 320 area. Nothing about the weekly chart would suggest that that is an imminent threat into the coming week's worth of trade. What would the volume profile have to show us? And then we'll move on down to the daily time frame chart here. We are rejecting the highest volume node, and the reason that I would say this is rejection is because we technically looked above, and again, the buyers could not hold near the highs of the weekly range. If a stronger move was going to unfold, you would want to see a push away from the high volume node, and then on any sort of retracements, you would then want to use it as an area of support. Because we were unable to close up here, to me, seems a little bit more bearish than bullish. As we know, though, if this is going to be a balance range, you still need to look for a breakdown underneath the bottom of that area, closer to 357. We'll see that on the daily in a moment. That opens up the low volume void, and this would be your first retracement closer to 340, and you can clearly see that that 320 retracement, the origin of the AI Mania breakout, is also an extremely high volume node. So on the QQQ weekly, a little bit more open-minded to the potential for chop and sideways activity. It's not as bearish as what we saw in the S&P. Expected move on the QQQ daily time frame chart would suggest some sort of extremely nuanced higher high. I would just call it an equal high at this point in time at 374.55. 355 or an equal low at the bottom here closer to 356 flat. So expected move is extremely neutral. In terms of daily trend, I would argue it's also neutral here. Maybe it's starting to find a little bit more firm of an uptrend, noting that we technically have lows, higher lows. This, of course, was your last high, and we've produced a higher high. More importantly, on the daily time frame chart, you need a higher low for me to have much more confidence in this daily uptrend. And of course, that would just be a retest of the top of this as a daily balance range. Ideally, the line in the sand is at 361.50. From a structural perspective, notice that we broke back down through the 50 SMA. We did not hold that area. We closed well underneath this as an overhead balance. And if we are going to pull back, there's multiple areas in here that could offer the higher low. So treat this to the downside as much more of a zone. In terms of the FOMC origin, right, notice that this rejection is right at that area as well. So technically speaking, is this a logical place for a lower high to be set? Also, as a reminder, if we come on over to our trend line set, let me auto zoom this for us over here. We are rejecting off of the resistance trend line. This is the exact same resistance trend line that I was just pointing out on the weekly time frame chart for our sort of pullback channel, if you will. We are on the back test of our major low from October trend line, which that gets the anchor, and then you can see the back test over here. So confluence with both of those resistance areas kind of makes sense for a pullback in this market. Out of the QQQ, as we were saying, it's much more important to look for any potential hold of this area in here. Let's actually go back to this level set. Before we do, one last thing, sorry for the jumping, but this as a head and shoulders or man ray pattern as we call it here, never actually broke down underneath the neckline of that pattern. That is noteworthy, and once again, one of the major reasons as to why the QQQ is slightly more bullish than our S&P at this point in time. The weekly area that needs to hold is this 357 right here, which is very much so aligned with the lower edge of this week's expected move. From a weekly perspective, this is the look below and fail. If this holds, technically you're remaining within the overall weekly balance. So I would like to see, if stronger buyers are going to get involved, a hold of this area, but technically speaking on the weekly, we're not really bearish until we're back down underneath this here on the daily at 357 and the lower edge of this week's expected move. Let's take a look at the anchored view app set just to be consistent over here on the QQQ as well. Here is the major band from everybody who participated prior to the AI Mania rally, and here is the AI Mania rally. The bottom anchored view apps of that overall segment are the green ones in here. And notice what those are providing confluence with. That is at that 361.50 area. So if the daily higher low is going to hold, this is your key area at 361.50. There's really no other way to put it. That is the ideal place for a daily higher low if a stronger trend reversal is going to maintain itself here in the QQQ for a move in the upward direction. Here it is on the hourly time frame chart. I think that everything is fairly straightforward here. You can see that we did, of course, get some sort of head and shoulders up here near the highs. We broke back down underneath the 50 SMA, and intraday, we did find a lower high underneath. So what's the game plan? It's a patience play. As you can see, this is coming from the opening range break of Monday's session. This is coming from the highs of the first attempt to get over this area here and close the FOMC follow-up gap. So we have 363.50, 362.50, and 361.50. This general area is where we're looking for, if the buyers are going to step up, some sort of reversal pattern back in the upward direction. That could look something like this, a head and shoulders, inverted head and shoulders on the hourly time frame chart. It could look something like this, a push lower, something like that for a double bottom. Buyers would want to get involved for a daily higher low to be set over some sort of neckline in this area. Then there's a big battle here at 368.50, the retest of the head and shoulders neckline, which caused this hourly breakdown in the first place. Bears, what they would want to see is some sort of rally that rejects for a lower high, comes into this area, another lower high breakdown in here, and the nail in the coffin, the worst thing that could happen for the QQQ hourly chart would be a lower high underneath 361.50, right? If we do just get a straight shot lower high in here, I would imagine that over time, we're not going to be aggressive on the 357, sort of holding the weekly balance in place. This lower high, to me, kicks off more so a massive failed break from this balance range. I would at least be targeting the bottom of that balance, which is much closer to 352 and clearly violates the look below and fail theory on the weekly time frame chart. Let's take a look at the anchored view apps here in short duration from an intraday perspective, and clearly clear as day, you can see that this area is going to act as key support, 361.50. That is enforcing that as a major area. And once again, daily higher low can be found there. Last thing we'll do here on the hourly chart is coming in with the fib from here up to the top. And what you'll notice is that you have your 61.8 perfect confluence with that 361.50 zone. So if the market is going to hold, you've got a lot of confluence around this area. It is a do or die area for the NASDAQ 100. And then the last thing we'll do here with the fibs is coming in from the top of the move down to this area and just pointing out that if the bears are going to remain in control here, at least in the short-term hourly trend, lower highs certainly make sense anywhere underneath the neckline of that head and shoulders. Let's take a look at some supporting evidence via our market internals. And what you'll notice over here is that it's technically a bit more bearish on the net volume count for the week here, actually flipping negative on the QQQ. However, notice that on Thursday, we did not actually breach negative 400 million, which is kind of surprising considering that the cumulative build over on the tick here was very, very substantial, right? We're talking about a negative 8,000 on the NASDAQ cumulative tick. You rarely get those types of moves. Obviously, your advanced decliner very similar to the S&P with a straight shot lower out of the gates, even though on the NQ, we were trying to consolidate into some sort of ascending triangle. The break came later on in the day. So this is confirming the breakdown was real, and this consolidation ahead of time really wasn't something to be a believer in. We'll put up a tweet on the screen right now. This is specific to the S&P, but if you noticed on Thursday, the dollar was going higher, rates were going higher as the market was trying to hold up, and this was plunging. It didn't really make sense. Longs were certainly less than desirable at that point in time. Obviously, there's a bearish edge confirming the breakdown here on the internals for the NASDAQ, but it really depends on what happens here at that 361.50 line in the sand. Let's take a look at the market profile for the NASDAQ side of things. We'll fire that one up over on this screen here, and it's extremely similar commentary. We do have a poor high. We'll begin with that over here on the NQ. Poor high at the top technically needs repair, but you have to get there first. If you take a look at the value area and point of control from the Friday session, we really didn't do anything meaningful to keep this rally afloat. This is the distribution number one, the upper distribution from the Monday session. Clearly, the point of control is lower. Value area is overlapping to down there. We are nowhere near. Value is completely clean and breakaway to the downside of that Thursday session. And again, you can think about the open inside of the upper distribution from Thursday on Friday's open, or even just in the single prints as an opportunity, a gift, if you will, to the buyers. They did not materialize on that. There's no price acceptance in the value area near the point of control from Thursday, and obviously everything else is history with a B-shaped profile indicating some sort of liquidation break in the downward direction. In terms of supporting evidence for the NASDAQ side of the market, let's go back on over to a daily time frame chart. I just want to take a quick look at something like the SMH, the semiconductors, and have a brief comment over here. This needs to hold over the inverted head and shoulders neckline if this is going to be more constructive for the QQQ to maintain the look below and fail, aka the bullish stance on the retest of 361.50. So SMH, if it's over 147.25, that is the bullish look here if this can hold for a daily higher low at some sort of trend line like that, and you would just be getting range compression at that point in time, looking for something to break, right? Be it this for the equal high here, or be it through the trend line to the downside for a test of the bottom of the range. Things certainly get way more dangerous underneath 143.40. We would have to update you with downside targets over on the QQQ. Lastly, we'll take a look at the QQQE for the NASDAQ equal weight. We'll get to the RSP when it comes time for the breadth indications, but while we're looking at the NASDAQ, there you go. This is do or die at 74.56. Notice that it did pull back aggressively. It did not hold the top of the balance range, which once again, this would be the equivalent of that 361.50 on the QQQ. We're already underneath it, but you technically have one last stop here, one more straw to break at 74.56. If we're underneath that, once again, really does not speak to extremely confident odds for the QQQ continuing in the upward direction. IWM weekly time frame chart, one of these things continues to be unlike any of the others. Notice that we finally have a red-bodied inverted hammer here, large upper wick, and of course this time around the sellers were able to go to the opening print and through the opening print for range expansion in the downward direction, giving us the red-bodied bar in the first place. So much more relative weakness out of small caps, and it's been the story for quite some time on the weekly time frame chart. We know that this head and shoulders was basically detrimental underneath the neckline, underneath the midpoint of this is an overall range. We find ourselves trading right back down at these equal lows on the weekly, and if we break it down to the extreme lows is basically the next stop, the lows from October, where the remainder of the broad market, the S&P and NASDAQ, both bottomed from. So the risk here in small caps is that we do get a larger break in the downward direction. We have not done anything impressive here. If we take a look at the anchored VWAPs on the weekly time frame chart, we're underneath all of the key inflection points here in the upper wick of last week's bar. We could not even make a retest of the neckline where the breakdown ultimately unfolded from, never mind even getting into the breakdown bar here, which took out the neckline in the first place. So extremely bearish on the Russell and small caps overall from the weekly perspective. Obviously, the anchor VWAPs kind of speak for themselves. If we take out the Fibonacci's from the top of the recent weekly range to the bottom, we're just spending more time underneath the 38.2. We had decent odds when we were trading up here saying, oh, look, maybe there's the opportunity for the 100% retracement. Just never happened. And now that we're underneath 38.2, it kind of works in the opposite way, right? The more time you spend underneath that 38.2, the more likely it is that you ultimately return to the bottom of that overall move. We're talking about 162 on the IWM weekly, so about roughly 8 points below us. That's not a easy to digest move for small caps here. That's really detrimental for the broad market and provides a really substantial headwind as we try to move forward from here. Let's take a look at the volume profile, see what else we can say about this. And we actually do have to open this one up to a little bit more than a 3-year chart. We don't want to be misleading here. We are at the high volume node, or as a matter of fact, just rejecting this high volume node. There's not much here. This is a low volume void actually at the bottom of the weekly chart here. The next major area to retest is actually underneath the pre-sickness high. This is the sickness breakdown. That's the pre-sickness high. We're talking about a move to or through that on the weekly time frame. And of course, from a pattern perspective, you have to start thinking about, is this nothing more than just a really large weekly bear flag, monthly bear flag? If it breaks down, not for nothing, a measured move just based on an extremely quick eyeball test. This is not precise whatsoever. We're just kind of eyeballing here. But you're talking about 130 on small caps. Again, talk about a headwind for the broad market as a whole if this ultimately does break. Again, nothing about this has broken yet, but all of the indications are there for more so weakness than anything else over in small caps. Let's take a look at the daily time frame chart here and see what else we can learn about IWM. Certainly just a straight up rejection and continuation of the downtrend with a lower high here near the upper edge of the expected move. And what you'll also notice is there was no attempt at all to find support, to find buyers on the retest of the hammer high breakout, which was Friday of 2 weeks ago. So overall, again, nobody stepped in on the retest. This was a very clear lower high on the daily time frame chart. The downtrend is very well defined. If we find ourselves back down at this equal low, closer to 169, the door is open to 164, right? So a lot of room to fall here in the downward direction. I don't want to be doom and gloom. Could we technically produce some sort of double bottom? Absolutely. It's always a possibility. But where do you become more bullish on that pattern? It's always up and over the neckline. So you're talking about a substantial test here of an equal low after a lower high in the overall trend sequence, breaking that well outside of the expected move, higher low above. Now we're talking. Now there might be something going on back in the upward direction. As of right now, really does not seem like a high probability outcome into the early stages of this upcoming week. Even on the daily time frame chart, the next lower high wants to be set anywhere underneath 174.75 because that was your prior pivot low in here and also rejection from there. It's the bottom of a 2-day range. As a matter of fact, let's take a look on the hourly time frame chart. We can see it as clear as day. There it is, prior lows, highs, and then that's the bottom of your 2-day range. That's technically the neckline of an hourly double top. Again, no attempt for support here at the retest of the hammer breakout area and any consolidation underneath roughly 172. I would say that the most bearish thing that can happen here is just hourly lower highs continue, daily lower highs continue in this area. We build out an hourly bear flag because technically speaking, we do have 100% retracement. You never want to be a short on the first attempt after a 100% retracement. Bear flag consolidation or a subsequent lower high that builds out descending triangle, something of that nature really opens the door through 169 for, once again, a deeper move towards 164. That's the next structural area. The lower edge of this week's expected move is at 165.78. So play at your own peril underneath 169. There's really not much there from a structural perspective. We can throw on our anchored VWAPs, and what we'll notice is that we're underneath all of them. If anything, there's a suggestion of a lower high here at 173.40, which is well underneath technically the more structurally relevant part here at 174.75. So no matter how you look at this chart, it of course is more bearish than bullish. If you take out the Fibonacci's, even if you come in from the Friday low up to the high, I mean, we're well underneath our 61.8. Any consolidation underneath here keeps us below the 61.8. There's not much really to talk about on the bull side here for the IWM. Once again, if this is going to act as support, if this is going to turn into a double bottom, that's fine. I would not be the first one to lay my neck out on the line at 169 under the circumstances of how we've arrived here. I would much more prefer to wait, be patient, wait for the reversal. If we're going to take out that neckline, it'll come in due time and we'll change our tone when we have to, but nothing about this chart currently, I know I sound like a broken record here, is bullish by any stretch of the imagination. Let's take a look at the market internals for the Russell side of the market, closing out neutral, but technically on the bear side here. Outflows on Thursday were substantial, getting to that negative 150 million. In terms of the advanced decline line, again, a straight shot lower on Thursday, bearish on Friday. Cumulative ticks speak for themselves as well, building out in the bearish direction. Really nothing, again, going on in the bull's favor here for the small caps. Let's take a brief glance at the market profile. And what you'll notice is Thursday, we open inside of this distribution area from the Wednesday session over the point of control even, and just nobody wants anything to do with small caps. Notice how aggressively we sell off from that Thursday open. There's just no looking back. There's basically no volume at price for any of these given points. We slice right through the poor low. There's no reattempt to get back above. Notice that B period actually finds a lower high underneath the low of Wednesday. So again, nobody wants anything to do with small caps. This is liquidation break. This is liquidation break. It's very emotionally driven selling here. And again, there's just simply no buyers to be found. Value area is clearly lower. Point of control is clearly lower on the Thursday session underneath the Monday low of day. Never mind, just not even in the upper distribution. Friday, also a new point of control low. Value area is lower, overlapping to down as compared to Thursday. I think this chart really speaks for itself. Now let's move into our intermarket relationship supporting evidence. What do we see out of the dollar? We finally got a little bit of a pullback, and lo and behold, it did coincide with the move higher we saw in the market. Notice on Thursday, the dollar was aggressively higher, putting that downward pressure on markets, and we did see a little bit of follow through on the Friday session. So the fact that we're holding a higher low over that 105.65 top of the overall balance from back here does strike me as a bullish indication from a technical perspective, indicating that yes, we could make a continuation move out of the dollar, furthering the downward pressure over here on equities below. If we take a look at supporting evidence like the gold contract, there's a really outsized move on Friday with global tensions. I believe that this was attributed to be sort of a flight to safety style move with oil as well. If you just take a look at the CL, what you'll notice is that was also aggressively higher on that Friday session. If you take a look at something like silver though, going back on over to the metals, notice that this still has an opportunity for a lower high on the back test. And if this does start to roll over, then obviously that continues to put upward pressure on the dollar. This is nothing more than a blip on the radar. If they both continue to move in tandem, right? If metals are moving higher and the dollar is moving higher, obviously one of them is sort of lying, but it would speak to elevated volatility in the market because of those global tensions. So keep that at the forefront of your mind if you notice that the dollar is higher in combination with sort of gold as a primary driver there. Let's take a look at interest rates via the TNX, what's going on with the 10-year. Notice that we gapped down on the CPI move from Thursday, but what happened? Of course, we rallied on the hotter than expected reports. So now that we're technically moving back in the upward direction after this pullback, to me, again, from a technical perspective, this was nothing more than a higher low that was just set. We're looking to see if the market's going to produce an equal high, if not a higher high, and continue this overall trend sequence in the upward direction, which in theory would put downward pressure on equities over here, especially as we head into earnings season. We'll talk about earnings in just a moment, but before we go there, let's take a look at the inverted ZT to see if this has any sort of implications for what the Fed is likely to do. Continuing to get this rolling over look here out of the inverted ZT. The longer that we spend underneath this, the more confident we are in a prolonged pause. Let's take a look at the tracker tool. So total alignment with the pause, prolonged pause with higher for longer at 525 to 550 basis points with a 93.8% probability of no change in the November timeframe, which as we can see is right here, coming sooner than we might expect. But if we take a look a little bit lower towards total probabilities, even in the timeframes where we were expecting a little bit of a higher probability for a hike, all of those are now at 30% or below, even after the hot CPI. And sometimes the Fed does tend to use Nikkei T over over here as a mouthpiece, and one of the pieces that he has put out as a writer over at the Wall Street Journal is that the swift rise in long-term treasury yields, if sustained, could bring the Fed's historic rate hiking cycle to an anticlimactic end. Basically some kind of indication that, hey, maybe this prolonged pause is going to be the case, even if that hotter than expected CPI inflation continues to be the case. At some point, I do believe the Fed's hand will be forced, but so far, it's been pretty well telegraphed that we might be done here, and the prolonged pause, which is in total alignment with the inverted ZT, total alignment with the Fed tracker tool, and even via Nikkei T over here, is looking pretty darn good. If you're over on the X app, you can go ahead and follow us, but this was just a big laughing point on the Thursday session, where good old Paul Krugman over here mentioned that, hey, the inflation war is over. CPI x food, energy, shelter, and used cars, aka everything, inflation's over. We got nothing to worry about. And that was kind of the running joke here that, hey man, you're not accounting for like nearly everything that people really pay out for. This is a very interesting chart. You can check out Mike's Twitter handle up here. Actually, we'll do this so you can see his Twitter handle right here, and then we'll go back in to the image. Always credit where credit is due. If we take a look at what's going on here, I want to just point out that services inflation really reared its ugly head again. Remember that services inflation is the sticky side of inflation, and this light pink area, if you will, is really the housing and shelter. You can see that here, right? And what you'll notice in the last print from CPI is that accelerated massively from a 1.2 to a 2.7, more than double, right? More than double on a month-over-month read. We were making some pretty decent progress. We had 3.2, 2.3, 1.8, 2.3, again 1.5. I mean, you can look at the numbers. In services inflation was coming in the downward direction. This massive resurgence really does not speak well, especially with energy and some of the things that we were making really good progress on, goods inflation specifically, with that resurging as well. Now you have sort of some of this work that was done from the Fed undoing itself. Now it's just one print. We'll see if this comes down in the next one. Remember that Jerome Powell has been pretty clear that, hey, 2 prints don't make a trend, 3 prints might not even make a trend. So we'll continue to see how he postures himself. Remember that we have 7 instances of Fed speakers this week, right? Here is the calendar over on forexfactory.com. This is the coming week's worth of trade. Empire State, here's Fed, here's Fed, here's Fed, here's Fed. It's a lot of the same speakers. Jerome Powell will be live at 12 p.m. on Thursday, so keep your wits about you for that one, and more Harker into the end of Friday's session as well. We get unemployment claims. It's going to be a loaded week. Core retail sales, industrial production. It's a loaded week, right? So I would not expect this one to be easy. Volatility is heightened right now, as we'll see in just a moment with more supporting evidence. And of course, we get the continuation of earnings season as well. Some heavy hitters that I would imagine we really want to start paying attention to are going to be ASML from a chip making perspective. Same thing with Taiwan Semiconductor. Tesla, of course, just being the heavy hitter that it is. Netflix, big part of the Fangman stocks. Morgan Stanley, Goldman Sachs from a banking perspective. We'll see if LMT, Lockheed Martin, has anything to say about the tensions overseas right now. And then we even move into things like SLB from a materials perspective. So overall, earnings season is here. It's on our doorstep. If earnings start to come in underneath the expectations, that's where I think that the market really accelerates in the downward direction. And we can start to pair that with, if we just go back on over here, some supporting evidence like the classic flight to safety style trade starting to reemerge. If you take a look at the TLT ratio to the S&P, we're still underneath this resistance trend line, but we are starting to flatten out down here. And notice the relative strength of the bond market on the Friday session in relationship to the S&P equities down below, right? If this continues to make an aggressive move in the upward direction, if we do end up breaking that resistance trend line, that would classically speak to lower risk appetite for equities down below, more of a flight to safety style trade unfolding. If we take a look at bonds in relationship to one another, the short end is still being favored. We are in uptrends here, here, and here. A little bit of a downtrend trying to be established with highs, lower highs, same thing here and here, but we're not in a full-blown downtrend yet on something like a weekly time frame chart, so still some uncertainty from the bond market's perspective, which once again speaks to overall volatility in this market environment. We could take a look at credit spreads and see what's going on from this point of view. The shorter duration is still pricing in higher odds of something bad happening, right? This aggressive breakout here, the big aggressive higher high over 1.09, that does not speak well to the short duration, like the here and now duration, which once again is why I'm of the belief that we can still find the monthly higher low after a short-term sort of capitulation in the downward direction, because this really hasn't aggressively accelerated over that 0.9. We did make a higher high, but on Friday, and even as that breakdown unfolded on Thursday and Friday collectively, we did not get back up to the equal high, never mind accelerate over that 0.9 in the first place. So longer or medium-term credit spreads still not expanding or widening as rapidly as short-term over here. Let's take a look at the HYG in isolation. Speaking of junk bonds, notice that there was a perfect divergence that did end up playing out into the end of the week where the HYG made a lower high, the S&P had an equal high, that's that double top we were just talking about, and we did break down through that neckline. So far in sync now that that divergence has played out. And just as a reminder, directionally on something like a yearly time frame chart, if we just do a quick little compare and contrast, lower high underneath the bottom end of the range. If we just go back to a similar time period for the S&P again, we're not arguing that we need to be all the way underneath here around 3,800, but again, directionally, this would be a headwind for broad markets as a whole, with junk debt really not catching any sort of a bid here underneath the bottom of its balance range. Let's take a look at Bitcoin and see what's going on with the digital gold. This is still putting in the head and shoulders pattern over here. If this does start to break down underneath the neckline, that would fuel the fire, I would say, over in equities and just speak to risk appetite decreasing if Bitcoin wants to break down underneath. The neckline at this point is more appropriately around $25,750 per coin. Let's move along and take a look at the breadth of the market, and this is certainly substantial to point out. We did produce another negative impression well underneath the zero line on this week's session, even with the rally that we saw earlier on. Intra-week, we were up around the zero line, but we closed out well underneath. So what this would say is, from a weekly perspective, once again, this is nothing more than a counter trend move in the context of an existing and fairly strong downtrend, I would say, with new highs versus lows underneath the zero line. To be more constructive, you got to get that positive, and certainly this is not a help as of last week's close. Let's take a look at SPX A200R stocks in the S&P trading over the 200 SMA. I mean, hardly changed even with the rebound rally that we saw, so that is certainly not helpful and well underneath the 50% mark. Let's take a look at the SPX A50R. This is underneath that 33 mark, which of course would just represent 33%. So is there the opportunity for a weekly lower high after a counter trend move? Absolutely. And again, more of a bearish indication overall. It's no longer in aggressively oversold territory. So I could imagine another leg lower with this breadth indication taking a little bit of a breather, no pun intended. Let's take a look at the RSP, what's going on with the equal weight S&P 500, back down at that 140. So if we start to spend more time underneath 140, it spells trouble for the weighted market, obviously down below. Really speaks to a non-hold, if you will, of the 430 over on the SPY for the clean daily higher low. This strikes me, if it breaks 140, as a bearish data point. And another big time threat at this point in time is the Dow transports. Notice that this did make an attempt to push away from 14.7 as a key area of support. We find ourselves right back down on it, and the transports basically closed out the week flat or negative, right on that key area. If this breaks down to a new lower low, what do you think that means for industrials up overhead? Certainly another leg lower over here as these continue to diverge. If we are truly going to see a look above and fail, it's not all that hard to imagine the bottom end of the range at 31,750 coming into sight as a potential target, another major headwind for the broad market as a whole. Let's move along and talk about volatility, because this is where we've certainly got some major concerns. Look at the VIX on Friday's session. The breakdown on Thursday, I would say, was much more abrupt and unexpected, yet on Friday is really where we see that continuation move out of the VIX back in the upward direction, right up to the highs of the most recent move at 2050. Obviously, it's continuing to hold 15 as support, and what was prior resistance turns to support, resistance, more support here. A break of this area really ushers in that capitulation style flush I was referring to in the intro. Hopefully you're not too mad at me for using a little bit of clickbait terminology, but it goes deeper than this. The volatility of the volatility index, we always say this is the precursor, 103. Look at the VVIX on Friday, strongly closing over 103. Your precursor has been set. The VIX itself is poised to break out up and over those equal highs. And if we take a look at volatility futures for all of the purists, we're headed back towards a backwardation near that zero line. We will have to update this shortly with the October futures expiring, but nonetheless, this is a step in the wrong direction if you want to see a stronger bottom being put in the S&P 500. So I'm still a believer that that monthly higher low, that's really the target. We're talking about 416.75, 415 in the SPY itself. One-day volatility extremely elevated down below as well. This is right back at the zero line. It really hasn't pushed down underneath more aggressively, like where we were a bit more comfortable in the 9 versus 30-day VIX. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Do me a favor and leave some feedback down below in the pinned comment so I can truly deliver the information in the most effective manner possible. That way everybody can enjoy and get kind of what they're looking for here. Apple is up first on the chopping block. What do we see out of Apple? Certainly, we closed the gap and some on the Thursday session, and now we're starting to pull back just a little bit. I think that the key inflection point is going to be here at 177.85, and if that does break, you can still look for a daily higher low at 174. On the hourly time frame chart, I think that it becomes much more clear that we're dealing with a very similar head and shoulders case like the QQQ. If we break down through that neckline, lo and behold, that is 177.85. You got a little bit of an interaction here at 176.50, but the major higher low needs to be found over 174. So depending on what the broad market does, I'd be looking for breakdowns of Apple 177.85 to act as confluence with the broad market, making a move in the downward direction. If we're just consolidating up here, maybe we build out some sort of hourly bull flag. We'll take that in stride depending on how strong the broad market indications ultimately are. Here's Netflix. This is really just something I'm not interested in trading whatsoever. It's not just that it's earnings, but if we go on down to an hourly time frame chart, the price action has been absolutely brutal and disrespectful. I mean, you get look below and fail, through the top of the range, another look above and fail, no hold for a higher low from here to here, through the bottom, no attempt at a lower. I mean, it's just been incredibly difficult to look at Netflix with a straight face and say, yes, this is something that I want to trade. So because of that sentiment, you could take a look at the levels that we have mapped out. We do have a gap to close underneath us from 346.25 down to 340.50. I'm just not going to be trading it early on this week or even interested until earnings passes. So therefore, I'm not really going to give you my take on it if I'm not actually going to put my money where my mouth is, so to speak. Here's Tesla. What do we see out of Tesla? It did not hold the key 258 level. Remember that this as a support trend line is basically where we opened on the Friday session. I was kind of optimistic, still looking for a daily higher low there. Obviously no dice on that hold. So the key watch going forward is any lower high attempts under that area at 258 really open the door for downside. Here it is on a daily time frame chart. We have our daily 50 SMA here. If it is going to act as support, I think that's a reasonable lower high to look for. And then you start to deal with a little bit of a head and shoulders here underneath the 50 SMA, underneath these equal lows. The door is open for continued downside. I would really be looking for the daily equal low at that point, closer to 235.50. So Tesla, it's got some work to do. It was a pretty influential breakdown on that Friday session, not holding up at the 258, especially after this bullish consolidation was put in. So bears, you're kind of in the driver's seat under 258. The most optimistic bearish thing is just rejecting cleanly 254.25, continue to trade for downside outcomes. There's this, and then your daily equal low is that level at 235.50. Where would I be a more content buyer out of Tesla? Only on a higher low back over 258. Maybe there's a reattempt back over this level, but you've got to prove it to me first. Again, this breakdown, fairly detrimental to the overall trend. Let's take a look at Google and just bring this one back up to a daily time frame chart to once again illustrate the zipper pattern. Thanks to Dow Jones Dave for pointing that one out. We've got a collab coming with YKK zippers, but nonetheless, what do we see here? I would certainly be more willing to look for a retest of these areas on a daily higher low. So a lot of tech right now is looking like it can pull back to find a higher low. That, in my opinion, could spur some of the selling that we need for the S&P to make that leg lower if these tech names are basically looking for higher lows. Now, if we start to hold them, that's a different story. Notice here out of Google, you could start to get confluence with your daily 50 SMA around this area. Here we go on the hourly time frame chart. You can certainly start to make the argument, just like many other things, head and shoulders, we're in a very short-term downtrend on the hourly chart at this point in time. This is hourly bear flag. Your next break is underneath this to get towards that retest level that we were just talking about, where you can slowly start to see that we would have confluence with the daily 50. So I'm really more interested in what the reaction is here around 135.25 to 134.25 out of something like Google. Let's continue along and take a look at Meta. This one's finally participating, I would say, in ultimately what we're looking for, right? Big break out of this as a long-standing balance range. So the break certainly doubled and hit the target as expected, or I should say as a measured move there. And this pullback is starting to become extremely interesting at 310.75. I would love to be a pullback buyer if the setup is right out of Meta for like a daily hammer down here back long over the hammer high, retest 319, then look for follow through. If the broad market's really struggling, something that we've been talking about in the pre-market preps is that this is actually the more attractive pullback because it also opens the door. If the broad market's struggling, great, you have yourself a daily lower high here. Now you can posture short off of 319 depending on what the broad market is doing. So really, really thrilled to watch Meta this week. 310.75 and 319 are the major inflection points that I'll be looking for both of those setups we just discussed. Either a pullback that does rally to that in the first place, place. If the broad market remains weak, we'll look for a lower high there. If the broad market really rebounds, we'll ultimately look for the equal high out of something like Meta, noting that the breakout of this sideways balance range was substantial in the first place. Failing underneath 310.75, right back in disrespect zone. Really do not want to be a participant in something that's proven to be extremely choppy. Here's NVIDIA, still on a daily time frame chart here out of NVDA. We're at the retest level, and that is going to be at 452, right? Prior highs, broke through it, kind of daily 50 SMA trying to meet us there for support. Aggressive pullback on the Friday session. So name of the game here is if it does hold up for support early on in the week, ultimately, let's go back down to the hourly actually. Ultimately, the big retest is going to be at the 461, right? You can see right here, intraday lower high on the hourly time frame chart. So holding here, I think that you have a trade on your hands to this area, and then again, broad market. Is it falling apart or is it holding together? That's going to inform the decision at 461. So NVIDIA and Meta do strike me as decent players here on the pullbacks. Google still has a little bit more work to do. Apple still has a little bit more work to do, but NVIDIA and Meta, the breakdowns are a little bit more substantial. We're testing key structure already. This is where my focus would be early on in the week. Microsoft, what do we see over here? It's more similar to the Google and Apple story where this as a balance range is just barely starting to go. You can see a lower high developing in the afternoon from Friday. So if this is going to be a breakdown play for stronger downside, we do have thin structure to retrace, then you'd be looking for 321 on the retest down below. If it comes back up into range, if the broad market does decide to hang on to hope, primarily that QQQ for the daily higher low off of 361, then Microsoft, my apologies, could be a player for a look below and fail back to the top on a higher low back over 328.25. Last but certainly not least, the mini beast is going to be Amazon, kind of a failed move into this overhead gap. Let's go to the daily so you can see that a little bit more clearly. Perfect rejection of the daily 50 SMA, not a full gap close. So once again, more similarly to the S&P commentary, it begs the question, if stronger sellers were going to get involved, which we did have an extremely decent looking inverse Man Ray pattern, right? If you want to count this as sort of your Man Ray, I guess it's still technically setting up. You need to either hold 129 and build out consolidation here for a continued break. But why was there no... To me, it should have been that the acceptance over that 131.75 intraday on the Thursday session was sort of the gatekeeper to keep this elevated in the gap and potentially look for the stronger move to up here around 138.60. It just never happened. The rejection of the 50 SMA on the daily is a little bit too strong. 129 is still that key level that you need to watch. If we just bring it back down to the hourly chart, you can see this as a lower balance range. If you produce some sort of hourly head and shoulders, again, think back to the QQQ, think back to what we were just describing over on Apple. This could be a player under 129 with lower highs if the broad market is experiencing weakness. But overall, I think that this failure of the gap overhead is the primary driver for believing in the sell side pressure in the first place. 3 trade ideas, and then you are on your way to enjoy the weekend. HD Home Depot is up first. What do we see? Ticker HD. It is producing a 3-bar play in the downward direction in a very aggressive downtrend here after setting some sort of weekly, potentially even just daily, lower high around that $300 mark. You can clearly see that there's a stronger base of support that we will start to target if there's a decent break underneath 288.50, but the intraday setup for at least a day trade is underneath 291.15. Here it is on the hourly time frame chart. Let me zoom in. You can see that we have 100% retracement. Then we start to build out this descending triangle, call it a bear flag, whatever you want to call it. If we take out all of these flat lows, your scalp is down to that 288.50, and then anything more severely underneath that is the 281.50. Once again, if the broad market is cooperating and playing for that weekly downtrend continuation, I would be more so of a player for 281.50 in Home Depot. Next up, and I would be not interested in this trade if we never break in the first place, or if we make a higher high up around 300. If we're trading up here, obviously the trade is off the table. Next up, let's take a look at Cisco. CSCO is the ticker on this one, Cisco Systems. Let's take a look at the daily chart first. What I want to point out here is that if we need longs and the broad market's really cooperating in the upward direction, then we have a very nice looking setup here over in Cisco. Notice the gap overhead, leaving thin structure to retrace. It's not the biggest range to be trading for. I mean, we're talking about a stock priced around $50 at this point in time. So just make sure you understand that when you get involved, it's not a fast mover like something like, your Tesla, for example. So just keep that in mind, but $1 gap overhead and $1 to consolidate underneath, right? Technically, if this is going to turn into a double bottom, just a break up and over that neckline unlocks the gap fill overhead. 54.40 closes at 55.40, and the consolidation keeps this valid as long as we're in this sideways range holding 53.40. So $1 up and $1 down in Cisco. As long as we're kind of in that range, this one will remain on our radar underneath and not so much interested in the trade. This is if we need longs, if the broad market is moving in the upward direction as a whole. Notice the long-term trend here is certainly up out of CSCO with just some minor damage done on the gap down from the FOMC-ish time frame. Last but certainly not least, let's take a look at Disney. The sort of no-touch stock might finally be back on the radar. The reason I would say that is because we did produce a lower low here, but notice that we immediately went back for the equal high. There was no lower high that was set. We're also at this resistance trend line, and if we break this, you guys know that I'm not a huge fan of resistance trend lines, so I'm just trying to illustrate that we have a lot of confluence on a move up and over 85.50. If this wants to turn into a daily bull flag after producing a lower low immediately back to the equal high, I think that there's at least legs for this to break up and over 85.50. You might not want to be the first one in the door, but higher lows above. The door is sort of open here for a rotation closer to 90.60. That's the next major structure that we have. If we take it on down to the hourly time frame chart, just to illustrate, very strong and impulsive move off of these lows. It's been in the headlines a little bit as well. If you get some sort of catalyst to bring it up and over 85.50, again, that continues the bull flag breakout, but look left, this has been a fairly structureless breakdown. Maybe you've got a little bit of resistance to contend with around that 87 mark, so maybe you wait for the higher low above, then look for the break over 87, then you go to 90.60, but overall, I just think that after producing a lower low, to see such a strong response in the upward direction and also to recapture the daily 50 SMA, I'm interested. If we just build out bull flag consolidation, I mean, the technical pattern is there, over 85.50, kind of looking for that long to unfold, and that is going to be that. Thanks for joining me for today's session of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a simple thumbs up. Again, some feedback is much appreciated on the pinned comment. We will be live at 8:15 on Monday morning, as we always are, for the pre-market prep. Hope to see you up in the penthouse office suite. And with that said, I wish you a green trading week.